Welcome to The Explainer. Bitcoin is absolutely on fire, hitting record highs. But all that global hype? Well, it doesn't even begin to tell the whole story. Today, we're going to cut through the noise and give you a pragmatic guide for the savvy investor, right here in Singapore, focusing on what's really going on.
And this is the number that's got everyone talking. Bitcoin didn't just beat its old record, it completely shattered it, rocketing past the 120,000 US dollar mark. It's a rally that's making headlines everywhere. So you've got to be asking, what is behind all this global excitement? Is this just another bubble waiting to pop, or is something fundamentally different this time around? All right, first up, let's take a look at the big picture. The powerful global forces that are pushing Bitcoin into completely uncharted territory.
You see, unlike the hype cycles of the past that were mostly driven by everyday folks, this 2025 rally is powered by a whole new engine. First, you've got a flood of institutional money. We're talking over $2 billion pouring into new regulated Bitcoin ETFs in the US. This is serious, big player capital. Then you add a more crypto-friendly political vibe that's calming fears about regulation. And the cherry on top? A classic short squeeze where people betting against Bitcoin got wiped out, forcing them to buy back in and pushing the price even higher. It was the perfect storm.
So what market analysts are saying is that we're deep in what they call the acceleration phase. This is that wild part of the cycle where the old rules just get thrown out the window. Once you break a new all-time high, you enter this period of pure price discovery, and it's defined by exactly what we're seeing: crazy volatility, the chance for huge profits, and of course, a media frenzy. But, and this is a huge but, history gives us a very, very clear warning. These incredible acceleration phases have always been followed by dramatic, painful crashes. Back in 2011, a 90% crash. In 2017, that famous run to almost 20 grand was followed by a long, brutal crypto winter. It's a pattern that any smart investor has to keep in the back of their mind as they watch these numbers climb today.
Okay, but now let's bring it home to Singapore, because this is where the story gets really interesting. Here, the narrative isn't about wild frenzy. It's all about pragmatism.
Now check this out. While the rest of the world seems to be in a buying mania, the data here tells a totally different story. Almost half of Singaporean crypto investors have actually been selling during this rally. It's an almost perfect 50-50 split between people taking profits and those holding on or buying more.
And this isn't panic selling. No, it's the exact opposite. As one expert put it, this shows a really savvy and mature approach. You have investors who got in at much lower prices who are now just systematically cashing in their gains. It's disciplined, it's strategic, and it's a world away from that hold on for dear life or hodl mentality that we saw in past bull runs.
And the data reveals this fascinating flight to quality. Instead of just spraying money across dozens of random altcoins, the most successful investors are concentrating on a small, focused portfolio of 2 to 5 quality assets. And the results? They speak for themselves. A 75% success rate for the focused approach versus just 40% for those who spread their bets too thin. It's about conviction, not just pure speculation.
You know, this kind of cautious, savvy behavior doesn't just happen in a vacuum. It's been deliberately shaped by the Monetary Authority of Singapore. The MAS has put up some really strict guardrails to protect us. They've banned high-risk activities like crypto lending for the general public. They demand that exchanges keep 90% of customer money in super secure offline cold wallets, and they've restricted public ads to stop all the hype. The result? It naturally filters for investors who are more deliberate and do their homework.
All right, so let's put this all together. We've seen the global frenzy, we've seen the Singaporean pragmatism. So what does this actually mean for you and your portfolio?
Really, the core dilemma is trying to figure out what Bitcoin is. On one hand, you have the digital gold story. Its fixed supply of 21 million coins makes it a shield against inflation. But then, on the other hand, it acts just like a risky tech stock, super sensitive to fear and hype in the market. It's kind of both of these things at once, and that's the tension you have to navigate.
Now let's put Bitcoin in context. When you stack it up against the kind of investments many of us in Singapore are familiar with, like REITs, the STI, Singapore savings bonds, well, the difference is night and day. Look at income. Bitcoin gives you none, while the others are built for it. And then look at risk.
Bitcoin is way out there on the extreme end of volatility, with rules that are still evolving. The others? Highly regulated and built for stability. It really is in a class of its own. And that brings us to maybe the most important shift in thinking here. The real question isn't a simple, should I buy Bitcoin, yes or no? The much smarter question is, does a small, high-risk allocation to an asset like this have a place in my otherwise balanced and diversified portfolio?
So for anyone here in Singapore who's even considering it, the smart money suggests a clear three-step framework. Step 1, be prudent with your allocation. Keep it to a small slice, maybe 5 to 10% of your portfolio, max. Step 2, and this is the golden rule, rigorous risk management. Only, and I mean only, invest what you are 100% prepared to lose. And step 3, which is non-negotiable here, is to use only MAS-licensed platforms. It's just smart protection.
So in the end, this is the question you're left with. It just perfectly sums up the trade-off that every informed investor has to think about right now. Is Bitcoin a calculated 5% bet on a potential future managed responsibly, or is it a 100% gamble on today's hype? The Singaporean approach seems to suggest the first path is by far the wiser one.